Good evening. Well, that's a lovely way to get started. I always wanted a real job, and now I work at TVS Capital. It's a privilege sitting next to Mr. Ananth, Narayan, Gopal. I've had a privilege of working, alongside him under his guidance. I served for many years on his advisory committee in SEBI. And Mr. Ananth to all of us, Ananth Narayan to all of you, needs no introduction. But I just want to remind you that he's had multiple decades of experience in financial markets, policy making. He served as the whole-time member for alternatives and many other things in SEBI. Currently, he's chosen to do duty at PFRDA on this newly committed SARC committee, which has a mouth-watering agenda, may I say, and potentially a very impactful agenda, a very important agenda. We had this opportunity to talk to him about, while you were serving at SEBI, I think there's some questions we wouldn't have been able to ask you, and now we have this opportunity to chat with you. Your tenure at SEBI will be remembered as a tenure of reform, path-breaking reform. There's so much that happened. And I think the most important feature of your tenure was your focus on anti-abuse and making the industry acceptable. India is a regulated financial market, highly regulated, preponderance of regulated capital, and mainstreaming of AIFs is contingent on the confidence they inspire, and a series of measures that promoted access for institutional capital into this sector on the back of anti-abuse provisions, that inspired confidence in the system. We remember how there was the whole back and forth on, for example, banking capital, and how we worked with you to undo that damage, Ananth. It's so important. There's 250,000 crores of deposits, 250,000 crores of, actually that's not right. That's 2 crore deposits of capital in the banking system, and some of that is coming into the AIF system, and all of that came to a standstill, and a series of measures that you took that helped reverse that, and today banks are again investing in AIFs, just to list one of those. And then your reforms around LVF, which is again to promote access for institutional investors, large value funds. For those of you who are not familiar, this is a low-touch regime in the AIF industry that allows institutional investors and GPs to work together. The co-investment framework. There's so much that happened, Ananth. Thank you so much for these years of path-breaking reform. I'm sure you can look back at your time at SEBI with at least a note of satisfaction.
No, first of all, I wish you're going to say, I'd known that you're going to say all these nice things. I would have called my wife also to come and listen to this. But, I just want to start by congratulating this ecosystem. If you look at the numbers, and I happened to look at the numbers today, just before coming, the December end numbers, nearly 16 lakh crores of commitments, over 6 lakh crores, almost 6.5 lakh crores of actual investments. The incremental numbers in terms of commitments, additional commitments in a year, are now rivaling flows into equity mutual funds. So the rise of this particular industry with 70% domestic funds is just remarkable. And I'm sure you will say this is despite regulations rather than because of regulations. And this growth has been really remarkable, which I think you guys deserve a round of applause. While we keep beating ourselves up and say, there's a lot more that we can do, and that's absolutely true. But the fact that we've come all this while, I think is really remarkable. My own journey, Gopal, if I had to reflect, by the way, I have to thank you for a second thing. My experience in my previous avatars in banking and in academia was more in public markets, particularly on asset classes which had nothing to do with the regular securities like equities. I was in currency markets, I was in bond markets, I was in credit and derivative markets. So for me, it was an education coming into, and likewise for SEBI, the unlisted space was frankly an education in many ways. I think it was incredible seeing that. I want to write a case about this one day. It was incredible seeing the transformation that at least I saw personally over 3 years. I have to admit, initially, the experience was not great because we had all these experiences of very smart structuring of AIFs to circumvent existing regulations in banking, in FEMA, in IBC, and even SEBI regulations. And that was an overhang. And we saw a significant number of cases which looked like circumventions. And that clearly biased the regulator against this particular industry at that point of time. And then working with IVCA, and I have to congratulate Rajat and the entire IVCA team, working with IVCA and with people like Gopal and all the stalwarts in the industry, it was such a journey moving from distrust to talking to each other and trying to arrive at a space where we can minimize misuse of AIFs, at the same time try and make it easier for the good people in the industry, the many good people, to actually do the capital formation that we so urgently require. And I think this journey will continue. I mean, you've had Mr. Tuhin Pandey come here, you've had Mr. Raman come here. Between Sanjay Malhotra, between Tuhin Pandey, between people like Raman, between people like Ajay Seth, I think you have the most open ecosystem possible to all kinds of positive change. So here is my advice to you as a former regulator. Abhi pucho, abhi mango. You will get a lot of things. But the only thing I would temper you with that is you have to self-police yourself as well so that we don't go through what we went through 3 years ago. Regulators don't know. People expect that, we are all, Bhagwan with 10 hands and 10 heads and we know what is happening. We don't. And so it's really a shock for us when we find out the hard way of something going wrong. Now, most of you in this room will know exactly what is going right and what is going wrong. And my strong suggestion is have that self-regulatory organization kind of a mindset in IVCA and don't wait for the regulator to find out these things. Make sure that you take care that things can't go wrong in the, on the circumventions, etc. And believe me, with that confidence, the regulator will move with open arms to make life easier for you on multiple fronts.
Indeed, those are golden words, and I think the industry will be served well by listening to them, because there is so much behind it. Ananth, we talk about Viksit Bharat. There's also talk of Atmanirbhar Bharat. It's not just a slogan. The world has been deglobalizing since the global financial crisis. And strategic autonomy is no longer just a slogan. It's really required. I mean, it's an imperative. Today, in a $4 trillion economy, private equity flows are roughly $40 billion. We aspire to be a $10 trillion economy. That means more productivity. That means our savings have to be parked in more productive avenues. Private equity inflows have to grow to what? At least $100 billion, maybe $200 billion a year. And today, 85% of all capital flows into this industry are foreign, non-Indian. Now, with this source of capital, we cannot get to $100 or $200 billion a year. So what makes the Indian private equity industry truly Indian?
It's a kind of a complicated question, but let me tell you my perspective on this. By the way, I think these numbers need to be refreshed, and I would strongly urge Rajat and company to take a fresh look at the numbers. As I mentioned, the commitments today in AIFs is about 16 lakh crores. 70% of those commitments are from domestic participants. And SEBI puts out the data on a quarterly basis, so the numbers are there for everyone to see. Now, earlier, of course, you also had a lot of private equity coming through FTI. Those numbers, by the way, if you look at the net numbers now, they have started to change very dramatically. You're seeing a lot of exits, obviously, with public markets doing the way they are. So to that extent, it's not as if this market is now dominated the way it was by foreigners. at least on an incremental basis. It's more domestic. The second thing I would want to leave you with, and I know I'm using an analogy of the public markets rather than private markets, but I think it applies to the private markets as well. Do you know that in FY25, fiscal year FY25, the total demand for equity, listed equity, public equity, albeit primary and secondary, was $100 billion across mutual funds, across pension funds, insurance companies, and domestic investors like you and me. $100 billion. We've never seen numbers like this before. We had about $15 billion equivalent of FPI outflows. Even then, it was net demand across primary and secondary of $85 billion. Against that, the fresh supply that came in through IPOs, FPOs, QIPs, rights issues, all of that put together was just $50 billion. So you had a gap of 35, by the way, both these are record numbers. $50 billion record number of issuances, $85 billion record number of amount of net demand as well. This differential between demand and supply was also a record and growing over the years. Now, I would argue, now I'm no longer in SEBI, so this is not a SEBI view, by the way. This kind of a differential is what makes for pockets of overvaluation, where there is not enough supply happening and not enough people creating new businesses. And because you have overvaluation, you have Korean companies which are issuing equity in India at 7 times the valuation they can get in their home country, right? So I would argue that a bit of this seems to be happening in the private markets as well. When we speak to private equity investors, they say that 15 years ago, we could get a lot of good entry points into India. Today, I see fantastic exit points, either through public markets or through fresh people coming through AIFs. So the first thing I would urge is we need our entrepreneurs, our intrapreneurs, our companies to issue more, to raise more. I don't think the constraint is people wanting to put capital. One fantastic thing that has happened over the last 6-7 years, when we say 14 crore unique investors in the equity market, there has been a financialization. You and I, we are willing to put patient capital into to play, to work with the value creators. What we need in this room is actual value creators who are going to create the next DeepSeek or the next big idea which will create the future. So I don't think it's a question of the demand for paper anymore. It's a question of getting good quality supply in the market.
And maybe the right channels. And I'm going to come back to this. I want to come back to domestic retail participation. But I can never forget that 2008 happened. There was no housing crisis in India. And Indian public markets fell by 60%. Yeah. And if you compare that to how we have navigated global crises more recently, I think we've taken control of our public markets, and that's a great example to follow in private markets. I want to take the discussion forward in the direction of what makes Indian private equity more Atmanirbhar. I mentioned how you now you've chosen to serve on the committee related to reforms in pension funds, the NPS system. But if you take EPFO, if you take NPS, and if you take insurance, and for a minute, just trusting these numbers, there's about $1 trillion. We love to talk in dollars. There's 115 trillion rupees of long-term capital in these three ecosystems. Very little of that capital currently flows into alternatives. And I'm sure you've thought about this. You're on the committee because you've thought about this. Why do you think so little of this flows into alternatives? And what can be done to change that?
So I'm not going to try and prejudge what the committee will come out with. I'm not the chairperson of the committee. Obviously, the call will be taken by PFRDA, by EPFO, by all those. But this is not
about the committee. This is rising to a higher level and talking about, yes.
I think we all will understand, and we all, I'm sure, manage our own whatever little wealth we have. The academic way of approaching this is very straightforward. You start off with figuring out what your risk appetite is. So supposing your risk appetite is annualized volatility of 20%, then you create a asset allocation, a diversified asset allocation across equity, across private equity, across commodities, across foreign currencies, across real estate, fixed income, all of that put together, such that that portfolio gives you a volatility of 20% and therefore maximizes, Harry Markowitz's the closest thing to a free lunch is diversification. So that's what you do. So in that, asset classes like private equity and AIFs definitely have a space. So it's even if you're a risk-averse person, putting out 5% or so into private capital is absolutely justified by Harry Markowitz and portfolio management theory. So I think there should be no doubt that, especially for 30-year-long savings that you're doing for pensions or for PFs, etc., you have to be investing in risk assets. You have to have a higher risk appetite that you would otherwise think you have. And therefore, you should be putting money into not just public markets, but also into real estate, into commodities, and into private markets as well. So what that percentage should be, we can argue about. In fact, we can do a lot of back testing to try and come out with some numbers, but that should be the broad principle in which you follow. So this is also a question of education, right? So unfortunately, and Rome wasn't built in a day. So when you put the idea that savings of government servants and state government servants need to go into unlisted capital, obviously the first reaction for the bureaucratic ecosystem could be, what are you doing with this money? This is, after all, you want to be safe with the money. So it's a question of education on explaining how portfolio management really works and how diversification actually gives you the best of managing your risks as well as your return. I think we will go down the path. And already, if I remember, Raman and PFRDA, they've already managed to move the equity percentage from 15 to 25%.
Indeed.
I would argue it needs to move to a lot higher percentage, and I would not call it equity. I would call it risk asset classes, maybe 60, 70%. That's what it needs to move towards. I think we'll move on that journey. That financialization is happening.
And does the answer partially also lie in innovation? So, what we hear from the pensions ecosystem is, why don't we have ultra long life products? And the way I read that is, permanent capital vehicles or open-ended AIFs. Do you think open-ended AIFs are also an innovation whose time has come?
So to start with, even the current regulations don't prevent you with coming with a 25-year AIF or a 50-year AIF. Nothing in the regulation stops you from saying, I hereby declare my tenure to be 50 years, right? I'll tell you why regulators don't like open-ended AIFs. Now, there are two risks that you're worried about as a regulator, and a regulator's job is to worry. One risk is, of course, investor protection. Now, you can argue in the case of AIFs, regulators should not be worried about investor protection, but I would counter-argue that will be true when every investor in an AIF is an accredited investor. Indeed. We have not gone there as yet. It is possible that a pensioner who has 2 crores of total wealth puts 1 crore in an AIF. So that's a situation which is not healthy. Anywhere else in the world, Singapore, in the US, you have to be an accredited investor before you can go into a hedge fund, right? I think that's the first part. Here is the solutions that I can give you as an industry. You move towards a 100% accredited investor model. I can tell you SEBI will kill every single, we had a panel earlier talking about pari passu and pro rata, which is essentially for investor protection. We can remove every single clause related to pari passu pro rata, provided you go to AIFs which have only accredited investors. Now, I know accredited investors is a painful process the way it stands. What you should ask SEBI, and you should pay me for suggesting this to you, what you should ask SEBI is, let us as fund managers certify who's an accredited investor. And you come and inspect us later on in case we're not doing our job properly.
That's a brilliant suggestion.
So make the process really simple, leave the manager, let the manager decide who's an accredited investor. Then argue to the regulator that don't worry about protecting an accredited investor because they have the wealth, they have the savvy, they understand markets better than SEBI does. And then we'll stay off that. Now, the second issue which goes beyond investor protection is on systemic stability. For instance, I think we have done a good job so far by not allowing leverage in Cat 1, Cat 2 AIFs. Right? One of the issues that you have in the US, which has $13 trillion of private equity, etc., is the financial system really doesn't know how much of leverage is embedded in that. Right? So imagine, now, what we can tell the RBI, what SEBI can tell RBI is, listen, you don't need to worry. What the money which has been put up is capital of people who are accredited, who can afford to lose this capital. And there is no interconnection with NBFCs or the banking system or the financial system, which can lead to a spillover and interconnectedness, right? The problem with an open-ended AIF is that the things that we went through, 15 years ago, with the debt burden hitting us and, the big companies, evergreening of loans happening, etc. That's the stuff that we are worried about could happen in an AIF which is into perpetuity, where there is a bad news, a particular investment is dead, but you keep it alive forever, and guess what? The LP, the GP, the sponsor, the manager, everybody is interested in pretending it's all okay. So I think the way to address this is to find a wire media with the regulator. I can assure you there are win-win solutions possible here. I don't think it's beyond us.
Thank you. Please ignore that because I think we started late. This is for the previous panel. Our time has just started. I want to move you to the other end of the spectrum, which is the retail end. You rightly said, thanks to retail participation, 14 crore demat accounts, there's 2 crore 50 lakh, there's 2 crore 50 lakh crore of deposits in India's banking system. Trust me, nobody's targeting them. It's only a way of reminding you of the power of retail investors. 100 billion of demand, 50 billion of supply. Taking a leaf, you came from public markets. You've seen the enormous success of mutual funds in India over the last 20 years. What can we replicate from the mutual fund industry to improve how we channel retail capital? Of course, with the appropriate safeguards, but through innovation, through the right product into this industry.
So let me break this up into parts. I think, at least personally, it's a very personal opinion. I'm not speaking for any committee members. Personally, I think there is a strong argument to be made to allowing some of the long-term pension savings, insurance savings, etc., to make their way into multiple asset classes, not just AIFs, not just private equity, also into infrastructure, into project finance, a whole bunch of long-term investments. I think there's a strong argument to be made. And that's a great way to channel retail money through savvy managers and, people who are overseeing the system to making sure that you're getting the best possible return for a particular risk acceptance criteria that you have. Okay, so that's one channel. The second channel, I think, which I would strongly urge the industry to pursue, look, eventually, if you want direct participation by individuals into private equity, into AIFs, etc., let's face it, we want to limit it to people who understand the risks. For instance, we have angel investments. Obviously, angel investments are very, very risky. The success ratios can be as low as 10% or 20%, which means you need to have 10 investments before you can, start to make sense of what the overall returns can look like, right? Now, you don't want a small individual who doesn't understand or doesn't have the capacity to evaluate, do due diligence on a project to actually be investing in that. So we've got to hunt down the accredited investors and get them into the tribe of being accredited investors, right? If you do that, now, by the way, there are about 9 lakh odd, taxpayers in the country who pay more than 1 crore of taxes, right? At least start by getting them on board and make them all accredited investors. Then I would go the next step. One of the things that you would want as an industry is you want a secondary market for your units in AIFs, right? You would want a secondary market for unlisted paper. Today, SEBI will not touch it with a barge pole because they will stay only to the listed space. But what stops us from developing an ecosystem where you have an exchange without LODR, without SEBI, without listing obligations?
Only for accredited
investors dealing in these kind of securities.
Now, you know what Ananth says before he goes to sleep and after he gets up? Accredited investor. Right? But absolutely, this is a key that unlocks so many doors. We have limited time. Rajat has stopped looking at me. He's so annoyed. I want to ask you a question about an unfinished agenda. You are a visionary. You served a term. The industry would have loved to see you serve longer. I wouldn't call it I want to call the unfinished agenda your vision for the industry. So what's your, let's say, 3-5 year, what's your wish list for the industry over the next 3 to 5 years, Ananth?
Yeah, I'm too down the food chain. Don't attribute too many things to me. Here's my quick 2 takeaways here. By the way, the 3 years I had as part of SEBI, I would count as the most exciting, the most fruitful part of my life. Here's my one recommendation to the many smart people in this room. Please think about having one stint as a policymaker or as a regulator, 3 years, 5 years, whatever the time is. It does wonders to you yourself in terms of giving you the experience of putting yourself in the other person's shoes and seeing the larger perspective. The second is this ecosystem requires it. I can tell you the industry is moving so rapidly ahead, and the incentive system, as you know, for the market participants is so much different from that for the regulator, that there will always be this big chasm between what the regulated know and what the regulator knows. Unless we have bright people like you coming out and joining the regulator, this chasm will remain forever, and it will be terrible for the industry as a whole, because we'll come up with terrible regulations which come in the way of capital formation. Look, my vision, or at least my dream for this industry, which I came to know only about 4 years ago, clearly if India has to define the future rather than react to it, and by the way, the future 10 years from now in every single industry, call it manufacturing, call it banking, call it capital markets, is going to be extremely different from what it is today. There is no doubt about it. I'm an old fogey. I'm now learning how to use Claude Cowork, and I'm impressed by how much it changes life. So we need entrepreneurs who can come up and create the next and define the future for us rather than react to it. The only people who can fund this kind of entrepreneurs is people in this room. Because you are bringing in that risk capital, willing to take on those risks, fund those startups, fund those Series A, Series Bs, all the way up, so that you create the next NVIDIA or the next Netflix or whatever emerges in the next 10, 15 years. Without this industry doing well, I can't see how we can get to define the future rather than just react to it.
Thank you so much, Ananth. And on that note, I'm going to just open up the floor to one question. I'm going to take the liberty of nominating Shrini to ask a question of Ananth. And with that, we'll bring the curtains down on this fireside chat. Shrini, if you're not, are you ready? Or it's either you or Jain. No, go for it. Go for it.
I didn't even get my coffee here before you put me under the bus. But Ananth, first of all, thanks for being such a great friend and guide to the industry. I would say, since he has asked me to ask you a specific question, and your favorite subject, as he says, is while you go to sleep or get up, is accredited investor. I would say that the glitches with regard to getting the accredited investor onboarded, while the industry could obviously take the responsibility of telling the regulator that, look, we will accredit the investor and hold us accountable for it. The reality on the ground, there are all kinds of investors in the market. And at some level, the industry would also want to have a objective criteria, which if defined by the regulator or if enabled by the regulator through digital medium, I think certainly the industry will be able to take on the responsibility. The question for you is that if we move to a regime of only accredited investor, which I can tell you that there's a divided opinion within the industry. There will be a set of fund managers who would be very happy to do only that. There may be another set of fund managers who may resist that. But at least for the sake of protection of the investors or the freedom for the investors, the manufacturers of the product, the fund managers, what could be the levels of freedom, including what you mentioned about leverage being allowed for a purely accredited investor, notwithstanding the systemic risk that you just talked about? Do you think that we could have a situation where there is a purely accredited investor funds, but where leverage is allowed, or where Indian fund managers can be competitive compared to global managers who use subscription line financing and other leverage to boost up their returns?
So, great set of observations, Shrini. Okay, so first, there are very, very objective criteria for defining who an accredited investor is. The same process which the accreditation agency follows today, which is determining whether you have minimum wealth of 7.5 crores, financial wealth of 3.75 crores, blah, blah, blah. And there are documents that you evidence for that. What happens currently is, by the way, the manager collects all of this, then sends it across to the accreditation agency, which charges you 10,000 rupees and takes its own sweet time to confirm that it's an accredited agency, accredited investor. I'm saying let's do away with that leg. You are anyway collecting the documents. You evidence that you have the documents. We go by documents. As long as you have the documents, go ahead. So even if something goes wrong later on, you have the documents with you. I think that's absolutely doable. Now, in terms of, by the way, we all have AI-only funds, which we started in December last year, right? So to that extent, this is a starting point for trying to see if this works. Here is my, offer to the industry. We did the math on this. There are about 75,000 unique investors in all your AIFs put together. When I left in October, that was the number. It might have gone up right now, okay? All of them pretty much qualify as accredited investors in our view. We don't see any challenge in all of them actually being accredited investors, okay? We saw what are the regulations that we have, how much of it goes towards investor protection, how much of it goes towards systemic issues and financial stability, etc. At least 35 to 40% is for investor protection. I would argue SEBI has no role applying rules on investor protection for this community. So that entire 40% of your circulars can come down if you simply say we move to accredited investors, go and put a gun on Mr. Pandey's head, saying, why do you have these regulations now? I think, and he'll be the first person to agree that remove it. So in terms of actual ease of doing business, 35 to 40% of your regulations will go away once you go into an AI-only regime. Every regulation which is to do with investor protection will go away or get diluted. Now, on things like leverage, that is a financial stability issue. And remember, there again, RBI will get involved, and rightly so. Because the moment you have leverage, you have an interconnectedness with the banking and the non-banking financial ecosystem. Then depending on when things go wrong, and things will eventually go wrong at some stage, you don't know what the spillover effects can be for the entire ecosystem. That I'm saying we can discuss whether, rather than having only zero leverage, can you have some kind of leverage? We can have the discussion. But again, be careful what you ask for, and you are the experts, you know what the interconnectedness are, and how do you make sure that these interconnectedness don't balloon into something which spirals into something else.
That is brilliant. Thank you so much. It was a privilege working alongside you. It was a privilege chatting with you here, Ananth. I hope you'll stay back for a few minutes and take a few more questions offline.
Thank you.